Welcome, everyone. I am John Ryan, and you are not watching a sports betting show or a run of the mill financial markets trading show. This is the Predictive Playbook technical trading show that features more than 60 years of personal trading experience from myself and my co host, Steve Merril of wagertalk.com. This is supposed to be a high octane adventure through the thrilling world of sports betting and trading strategies and opportunities in the markets. I was formerly a chief currency strategist back in the 90s and have a lot of experience with this, certainly a lot more than on the sports end. And just at the point in my life where I want to start sharing it. A bout with a blood cancer in 2000 shortened my career on Wall Street and prevented me from being able to go back to that fantastic, thrilling, exhilarating type of career. But I found other avenues, and there's been a lot of blessings being cured of multiple myeloma, and that is a incurable form of blood cancer. So I am blessed beyond belief. Became a grandfather about a month ago. Tomorrow, actually Friday, will be a month. So we'll have a big birthday celebration for him. And let's get right to it now. Let's just get right into the nuts and bolts of what I have here. The one thing I wanted to start with is the fact that Steve Merrill will be joining me shortly, unless he had a technical issue going on. But in terms of the market, the Nvidia situation has been absolutely just unbelievable. And what we have here with this particular market is, and this screen is the S&P 500. So you can't see all 500. I don't have to scroll up and down. But let me get rid of this little tab here. You can see that Microsoft is the biggest in the world at 3,025,488,000,000. And you can see how fast it trades and changes in the market cap. It's mind blowing. Second is Apple at 2.8 trillion. Then we have Nvidia, which is taking a bit of profits today, down 4.77 at $782 a share at 1.955 trillion. It was over 2 trillion several times in the last couple of days, but it does stand to reason that we're looking at some profit taking today and maybe the beginnings of a pretty significant top. And we'll have to see what Steve says about that. Then we have Google and Amazon next in line. Amazon 1.8 trillion, 1.7 trillion for Google. Meta, formerly known as Facebook, 1.2 trillion. Then we have Berkshire Hathaway and Warren Buffett coming up on 900 million. But the ranges that we have seen recently in the live market for Nvidia is astounding. In fact, the moves have been in excess of $300 billion in move. It was $1.6 trillion, and now it's 1.9. It was over 2. But some of these moves have been happening in the course of 24 hours. Now, if we scroll down here, we get down to 300 billion. Right here is where it starts, right in the middle of the page. 306, Oracle. 289, Salesforce. 284, Advanced Micro Devices. 282, Chevron, Bank of America, Coca-Cola. So the move in one day by Nvidia is more market cap value than all of these S&P 500 stocks. So it's literally like 92% are in this realm where their market cap is actually smaller than the one-day move from Nvidia this past week. So it truly is remarkable. The volatility is a bit of a red flag. Usually when you get this kind of volatility in any stock, regardless of the market cap size, it does become a bit of a concern and maybe a topping action. There was a big move down to 680-ish before the earnings came out. The earnings were spectacular, and the stock went from 680 all the way up to almost 800, then 800 after the following day. So it really is in a major, major bull trend still. And this is Nvidia right here with the trend over the last year. Really, this is, I mean, just look at it. It's just amazing how strong. It looks like the candlesticks is just absolutely green with a speckle of red here and there. We're going to enlarge this now, and this is the last couple of weeks. So you can see where it sold off right here, down to about 650 on that day before the earnings. And this actually is the earnings day. The earnings came out at 4 p.m. And then we have a big surge up the following day in the aftermath of the spectacular earnings and the exuberance that maybe irrational exuberance that investors are now beginning to have with buying anything that has AI in it. For example, if it was John Ryan AI, I'd probably have possibly 10,000 viewers right now, but I don't like doing shows to exploit that kind of stuff anyway. But then in the last couple of days here, we've had some negative type of profit taking. There's still a lot of tremendous buying power underneath the market here, and really, it would be surprising at this point to see it go down below 760. But I am looking for an opportunity to create a bear spread. And what a bear spread is simply buying of puts. And then you're going to sell another strike, which is further out of the money, short. And that creates the bear spread. And with volatility as high as it is on Nvidia, it probably is going to be a very good trade. So I will be posting that at the predictiveplaybook.com when that signal is confirmed. And you do what you want with these. These are signals, and that's about all we're trying to provide. Welcome to the show, Steve.
Hey, John, great to be here.
I'm just going over Nvidia here, and the volatility. I'm mentioning that I'm starting to get signals to put on a bear spread in the options market, and that would be roughly looking at a potential maybe a 750 strike going long, and then selling the 725s, for example. The volatility on the options market in Nvidia is extraordinarily high, so you don't want to be just buying straight puts here, because the time decay is going to be astronomically large, and it's going to be astronomically against you. So what I'm saying is, out of the money put and call options are going to deteriorate in terms of their worth in an increasingly rapid fashion as Nvidia kind of finds a consolidation. But I do think there could be a pretty significant correction from this just gigantic run up, and you'll like this part. Let's see here. This is the S&P 500. So you probably can't read it, but hopefully the viewers can. Microsoft is first, 3 trillion. Then we have Apple, 2.8. Nvidia is now third, 1.957. It was over 2 trillion the last couple of days intraday, but it subsequently been suffering to some expected profit taking. But the move on that day, back to this stock, this move right here, that was after the earnings, which were spectacular, just a monster gap. It didn't look like much on the chart, and that's because I have other indicators here that are kind of not giving it the power that I want to demonstrate here. But this move right here is about $300 billion. It's just a monster move. It's the all-time record in stock market history for one day from open to close. So it is amazing. And the point is that we go back to this chart of the S&P 500. Here's the spreadsheet of it. You go down to 300 billion right here. Oracle's 306. So there's approximately 20 stocks that have higher market caps in the S&P 500 than the one-day move in Nvidia.
Yeah, I mean, it'd be interesting to go back, if you could ever back test and see when other stocks have made near historical moves like that, what they've done, the next 6 months or so, whether it's good. It just shows the uncertainty. And that's why you said the option market's going to have extreme volatility, because when you get the greatest move in the history of the stock market, obviously you're going to have a bigger spread in those option market volatilities as well.
That's a great point. I began to run that study, actually, and we'll present the findings on the next week's show. I'll have it easily done by next week's show. But what I'm finding initially is that these monster moves continue. There may be a correction after an earnings announcement and a record move of this size, or a record move for a specific company, not necessarily the market's all-time high, biggest move, but it generally will continue in the direction of that trend. So conversely, if you have just a horrible earnings report and the stock craters, it is very likely that you may get some consolidation as the market tries to find an equilibrium, but then ultimately 3, 6, 9 months down the road, it's probably going to be lower. So we'll have to see how that pans out. I know Apple has had some gigantic moves, not really recently, but when they were coming up on a trillion the first time, they had a couple, just monster moves, but it was nothing even remotely comparable to what Nvidia did this past week. It's just crazy, and
Got a
it's almost
couple of
fun to watch these numbers change. And I've been doing this for what, more years. You and I combined, it's more years than we care to admit. But you can see like how much just a penny in the price of the stock is worth millions. It's kind of mind blowing.
Well, we've
But
talked a
anyway,
lot about how top heavy the S&P is, and it's more so than ever. And I meant to send this to you the
yep,
other day. I saw this weekend a study that the top 10% right now market cap, it's the highest percentage ever. The only other two times it's been this high in history, 1929 and 2001. How's that stick you?
woo,
Yeah, so
1929. Wow.
yeah, so I mean, and the other one was right near there was like around the 2001 era, that range. So I've been saying this like on every show we've done for quite a while now that I don't know how it's going to end, but when you have an S&P 500 and it's literally, it's not even 10, it's really like 6 or 7 like you're showing, make up that high majority of it. I mean, that's why the market has been so good. That's why the market rebounded after COVID, because those were mostly tech stocks, Amazon, Netflix, Tesla, everyone loves, Google, Microsoft, those type of companies have done well. But if something goes wrong, it's going to take everyone down with them. And Nvidia, you just wonder if Nvidia is kind of the beginning of that, because you shouldn't see that. I guess here's a good point. You shouldn't see that kind of volatility in like a Class A blue chip, right? Like a Class A NBA or NFL team. You shouldn't see that kind of volatility in them. They,
Yep.
like IBM should be slow and steady, right? Back in the day when they were the biggest company in the 70s and 80s. And that's not the case anymore. Like the big boys now are very volatile. Tesla's very volatile. Apple not as much so. And that's the one. If something ever happened with Apple, that's when I'd say be very, very careful. But still, for Nvidia to be one of those top 10 and for it to be the highest percentage in history, other than 1929 and 2001, you do wonder if maybe this is the first crack that's starting to show that something's not right.
Yep, I'm with you, and it's scary, and we're not trying to scare people here either. But it is a concern how complacent the market is, and let's bring up that chart. We're going to go to the S&P 500 futures. This is the March contract. For those that don't know about futures, they're just tremendous leverage, very risky. Certainly not for everybody to start trading when you're first learning. In fact, I would advise not to do that. It's much better to paper trade and get a feel for how violent these moves can be, because it's not like betting on a sporting event and you have $100 bet on a team and it loses, you lost 100. This is kind of open ended, and if you get caught the wrong way, these markets can move extraordinarily fast. So it's like putting up $100 and the overall bet size is probably $2,500. So your max loss, say in this instance, could be $2,500, but you only have to put up $100 to have that bet being live. And that's the thing you really have to understand with futures trading is the risk is extraordinary. At least with options, you have a defined loss. If you are long the option, meaning you buy puts, buy calls, that whatever you paid for those options is the most you can lose. It's when you short options and short stocks, the loss is open ended, because theoretically, well, not theoretically, I mean, the price could go to infinity, right? I mean, it could go up so much that it would eliminate all your wealth. And you just want to avoid those situations. So this is the S&P 500, and sentiment is still 85, Steve. It's starting to hook down now. It's kind of similar to this situation right here. So I'm thinking that we could get at least a 300-400 point move down in the S&P 500 here between now and certainly the end of May. And we did put on those in the SPX. We did put on those 458 puts. Let's see here in the spiders, and we're 503. So 458 is a tremendous move, but it doesn't have to get to 458. It really needs to get down to 470, and that option will probably quadruple in value. But what do you think of overall with the S&P 500? Are we topping now? Or do you think we have another squeeze up yet before we top? Or, you know, thoughts on trades?
Yeah, I mean, there's always a long-term bias towards the upside. I mean, for numerous reasons. I mean, first of all, the S&P 500 is a trend-following index. It's market cap weighted, and like we just said, 10%. The top 10 companies make up the majority of the index because they're the winners. And so I like trend following, and the S&P works because it is trend following. Um, and there's also an upside bias because there's money going in it all the time with 401ks and retirement plans and just, closet indexers. Most financial advisors are just the S&P. So you don't really, that's another reason you don't really want to be short, like you said, because there's an infinite upside for as far as what your losses can be when you get it wrong. But I still think it's overpriced. As I mentioned earlier, I think there's a lot of concern with it being so heavy with those top 10 companies, historically heavy, that I'm not looking to necessarily short it, but I don't think it's really necessarily a buy up right now. I think you're going to get a very small return. I think you're probably better off picking individual companies. I would actually say if you could do the S&P 490, get those top 10 companies out of there. I know there are some ETFs out there that take out like Apple, I think, or the top company might
Yep.
be Microsoft now. But yeah, there again, if you could find a basket of like the bottom 490, I think that's going to probably outperform still long run over the next year or two.
Yeah, I agree 100%. It's hard to not be involved with the top big ones because they've done so much better than everybody else. But that gap that is formed now that you mentioned that's got to get corrected somehow, and it usually gets corrected in a pretty steep slide. The 480 puts, I think I was saying 580, but a 480 puts on the spiders is what we recommended on the show, or at least I suggested looking at as a, if you have a big 401k plan, this is a way to possibly hedge it and insulate yourself from some of the loss that could occur with a correction. But for a specific trade idea, I thought that we would start heading down here between now and basically the third Friday of March is when these options expire, and the price was 111 on the time of the show, and you can see it's unchanged. So it's going to have to go sooner rather than later, but we do have 4 more weeks here until the expiration occurs. So for example, if we dropped 1,000 points in the Dow over the course of the next 2 weeks, that would put us at an index of roughly like five. Let's see, off the top of my head, like that would be about 580, 485 on the spiders. So that would give you about a 40% increase in value, and you take the profit and look for the next one. So I think if we get anywhere close to $1.50 on these options, that's a good place to liquidate, and you never go broke taking a profit, right?
Yeah, that's right. I mean, you definitely want to have a strategy when you're going into options as well. Every option is going to eventually expire worthless for the most part if you're not careful. So
Right.
you want to have you don't want to be on the fly, just like if you're in the middle of the market correction on a single day. You want to already have a game plan before that day starts where you're going to buy, and that's why stop losses on any trade. We talk about the natural gas trade so much. It keeps going down and down, but you have a very tight stop loss. So that a couple months ago, if you got in, you got stopped out. It's even lower now, but you didn't lose a lot, and you still had an infinite upside. And that's the thing with options: you have an infinite upside, but that time decay is a real concern, and you definitely have to have a strategy of when you're going to liquidate because most options expire worthless, as you know.
That's true, unless they're in the money. If they're out of the money, they're worthless. We'll have to do a show just on the terminology for options trading. It's a language unto its own. But this is natural gas, Steve, and I've become pretty bullish now on natural gas. We have the moving averages starting to turn over and back up, crossing each other at this point. 2 nice days here. It doesn't look like much because we're coming from 360 and made a low right down in here. What is that? 152. So it's lost, more than double its value. And if you go back to the beginning, I guess the high was 7, so it's basically lost 80% of its value at this point. But this looks like a pretty good beginning trend for a bull move, and the signal here, the MACD long entry is what the LE stands for. And MACD is moving average convergence, divergence, where we're looking for divergences in the indicators and the moving averages, and they're either bullish or bearish. In this case, this is a bullish MACD event, and if you follow this type of technical indicator, this would get you buying natural gas. So do you think I'm right here, Steve, or do you think it goes much more? Is this the beginning of a multi-year type of bull trend? Those are the $1 million questions.
Well, what I like about this versus, when we were talking about it a few months ago, is you mentioned the moving averages have rolled over and they're starting to trend up. And I think that's a huge thing. And the other thing you look at as well, it had a little bit of the uptick there where you are right there. Then it came right back down, but it did not come back down to the recent low, which you're on there. And then the last couple of bars there have broken out above that resistance from a few days ago. So a lot of positives. And even if we're wrong, once again, your stop loss is so tight, you just set it below the low there, a couple points below that recent low. And as you said, 7, it was 10 like a year ago. I mean, the risk reward is still like 6, 7 to 1 if you make that trade right now. So I think it makes a lot of sense. And this is also something that can't go to zero. We keep talking about that. It's a commodity. It's a resource that's needed. It's not a stock that's going to go bankrupt. So, I mean, yes, your risk is like 1.8 basically, but that's not even reasonable because it can't go to zero. It probably can't even go to 1. I mean, you'd have to know a little bit more about natural gas to know how low it could really go. But I mean, at this point, the risk reward ratio is just incredibly good to the upside.
Yep, and here are the options. So I was thinking like the $2. Well, these expire too soon. Let me just change it. Let's go to we'll go to the Mays. Well, I think that's what I clicked on actually. Let's go to June. We don't want physical. We want the financial. Okay, so a strike price of 2 isn't that far away, and they're trading at 12 cents, basically 12.2 cents, 12.5 to buy. Bid is to sell, ask is to buy. The market makers get the middle, and it's very similar to the VIG in sports betting. You can get a team at plus 10 or minus 10, but you're paying minus 110 VIG. So it's a little different in how it's calculated, but there's a commission for providing the market. But I think we'll keep a track of this right here. These are the May expiration for natural gas, and this would be a high leverage trade. The most you could lose is 12.5 cents per contract, and that if you bought one contract, I believe it would cost you $125 to own that contract. So we'll keep a look on that one, Steve, and see how that goes. But I think this thing could squeeze up pretty sharply and pretty fast.
Yeah, just to put it in perspective, I'm looking here. The summer of 2022, just a year and a half ago, it was as high as 17. I mean, and the low has been, it was like around the 3s and 2s about a year ago. Now it's like in the low 1.8, 1.7, like you said. So that's 1.7 to 17 is a 10 to 1 ratio. And it can only go down about another 1. So you're literally talking about a 10 to 1 risk reward ratio. It's just insane for something that is going to be needed for the next decades. I mean, and it just doesn't make sense to me. I know they found more resources, they found easier ways to get to it, and it was, it did explode more so to the upside. It overexploded because of the war, I think, in Ukraine, which turned out not to be an issue with the natural gas. But still, I mean, this is going to be one of those trades. It's like gold. When I started trading about 25 years ago, like right around 2000, gold was around like 200. It was one of the lowest it had ever been at the time. It just didn't make sense to me then either. And then it finally, when we had a little bit of a recession, it got up to 400 or 500. Now it's like at 2000. Natural gas, I think we're going to look back 5-10 years from now and just be like, boy, 1.7, just like gold, 20 years ago was 200. And it's not like gold is something that's new. It's been around for centuries, thousands of years, so these things can get vastly underpriced and they lose its favor. And also your sentiment is starting to turn there too, John, which I like at the bottom.
Yep. And
we've talked about that.
This is a weekly chart. So it goes like this is, one of the peaks here at 10, 9, upper 9s back in August of 22. And then the fact that the sentiment is this bad, this negative, this bearish is historically, it's hard to find any market that has gone to 10 on a scale of 0 to 100. And theoretically, it cannot go to exactly 0 or exactly 100. And very rarely do we get bulls in the 90% category. So that's very constructive when this market begins to turn like I think it is. That's going to that's what short squeezes do. It gets rid of the bearish sentiment that has been dominating the market, and everybody thinks that it's just going to keep going lower, kind of like Nvidia. It's just going to go up to, next stop is 900, next stop is 1,000. You might hear somebody at your local bar saying they own it, and the broker said not to sell it until it gets to 1,200. Those are warning signs, because it's like we always go to the Bitcoin, and that's where I'm going to go right now. When it first came out, everybody that owned it or said they owned it when it was like 10,000, 11,000 bucks, said it was going to the moon, and the moon meant like 400 grand. And it was just kind of universally accepted that this was going to be free money. And it was only a matter of months until this would occur. We know now that it did get up to 60 twice, but then it came back down. And as you like to say, the first day that the Chicago Mercantile Exchange opened Bitcoin futures trading was the high, and that was at 20, and then it went back down to, I guess, like 5 or 6.
Yeah, I mean, never ticked higher. The first day that you could actually short the market, which makes sense in hindsight, obviously, and that's the one thing that's different about now. I got this one a little bit wrong. I haven't been involved, but I did think maybe once the ETFs all went legal a month ago, that would have been the near-term high like we saw with the CME. But the difference in hindsight is that, back in 2016, 17 was really the first time ever that you could short Bitcoin. You could only buy and hold. Obviously, the commodity markets gives you a easy two-way. The ETF, that was not the case because the CME's been around for 5-6 years already. And if anything, I think what I missed on the whole ETF thing was, once I know there's a lot of front running with the news, it's buy the rumor, sell the news type thing. But once the ETFs went live a month ago, people were really able to buy it even easier, which means you had to have more people buying. The funds had to buy more Bitcoin, and that's why it's run up even more. So in hindsight, it probably was obvious that it should have ridden up more than we realized. But you look at your sentiment indicators, you just look at the extreme angle of that move. Things don't go straight up that fast and hold. And what we've seen here in the last few bars there, that's just an exponential, like straight up 100% up. It's just, this is not the time to get in.
Yeah. And it's basically doubled since right around October 30th. It was like 31,000, and now we're 60, almost 62. We were as high as 65, I think, today. Here, let me blow this up a little bit. Oh, I didn't want to do that. Here we go. Yeah, so to your point, look at the candle. The high today was at 64,990. And once it made that high, it's lost almost half of the gain. So this is fast becoming an inverted hammer. And if we would close, we don't have too much more trading today, but if we would close below 60,000 a day, that actually would end up being pretty negative.
John, pull up a longer term, like a week or even a monthly. That's got to be near that all-time high, which is a hell of a coincidence.
It is. Right here, this is 3 years.
I mean, look at that, and they're all look at all of those weren't like closes either. They were all extreme peaks and then came back down.
Yep.
I mean, that's just people don't think support and resistance levels are a real thing. I mean, and even though that's years apart. Now, with that said, if it was to hold and break out for a week or so and hold above this level that it just peaked at, that would be the complete. Then it becomes support. But my guess is this is going to be near-term resistance. And once again, from a risk-reward perspective, have a tight stop loss, maybe even use options, now that you can do that, because there is still an unlimited upside. It could go to 200,000, right? And it's not going to go below probably 20 or 30 ever again. But I think from a trade, looking for some reasons to start getting short, and we'll see how this plays out the next day or two. But that looks like a peak to me.
And look at the this is the all-time high, 69,355, and look at the candlestick that formed on that day. and this is a week. This is
Right.
a weekly chart,
Look at
but
the week
that's an
after it.
inverted hammer. Much like we're seeing on the daily. Right now, the weekly here is not an inverted hammer, but I didn't want to do that. This Fibonacci stuff. But yeah, it's engaging. It's interesting. And markets, they have a heartbeat of their own, and they're going to go any direction that they go, and the market is always right. It's not that you make a bad trade and the market was wrong. I was right. If you make money, you're right. You called the trend right. It's just like saying that if the Boston Celtics cover the spread against the Sixers like they did last night, and you bet on the Celtics, then that's a good trade. That's a good result. But the financial markets are different than sports betting. As I said earlier, that the volatility and the amount of potential loss and gain is much, much greater, astronomically greater than in sports betting. And trading is very serious. It is extraordinarily serious thing to be doing, and you can't do it with pizza money like we do. We talk about that in sports betting, and sports betting should be fun. You're watching an entertainment on your TV or at your sports bar, and it should be fun. It should be adding to the fun. You won't see too many smiling faces, whether they're winning or losing, with traders staring at a screen and watching the market move and trying to anticipate what the next move is going to be. But it's still incredibly enjoyable to do.
Yeah, and the analogy I'd use on that is, trying to figure out what the next tick is like trying to figure out which hand the basketball player is going to dribble with next, right or left. It's almost it's inconsequential. And that'd be like on a millisecond,
Yep.
right? And then if you're looking at, say, a 5-minute chart, that's like trying to figure out which team is going to maybe outscore the team. Say they're two evenly balanced teams. Say the game's a pick 'em. Trying to figure out which team's going to have more points in the next 5 minutes, and then the NBA game's like a 5-minute chart, right? But then if you go to a 4-hour chart, would be like maybe a halftime line. If you go to a 1-day chart, that's like one game. If you go to a 1-week chart, that's like 5 games. You go to a 1-month chart, that gets closer to the full season, and things do return to the norm at that point. But yeah, people think they can trade these 1-minute charts or whatnot. I mean, that's like trying to guess the next team that's going to score 2 baskets in a basketball game, and we all know how random that could be. The best and the worst teams are going to go through droughts where they don't score the next 2 baskets. So I think it's a forest from the trees outlook also. What I do like to do, John, and something mentioned is, I do like to look at both the daily and weekly charts. And then when they both have similar support resistance levels or breakouts, when they look similar, that's when I get pretty interested. In like Bitcoin, that's not the case. Like the daily chart on Bitcoin right now is at like at a multi-year high. And even though it did peak today, that was still a monster move, and it's still up substantial for the day, like you were saying. It's not really a hammer because it was still a big winning move. Whereas like that natural gas chart, I think we finally have where the weekly and the dailies are starting to look like they're rolling over together. And that's something I love to see. And I think that makes the strongest trades you can find.
I took off the MACD indicator just to show the viewers that this is what you were talking about. So this is let's go to a weekly quick. And this is the S&P 500 futures. So here's 3 years of weekly candlesticks. Okay, and we're this little red thing here. Now we're going to go to a daily. Kind of still the same.
Very similar, yeah.
And then we get into the good stuff. Here's 20 days. Each bar is an hour. And I'll blow it up a little bit. So this looks like a totally different commodity. This doesn't even look like what we were just looking at, because every bar is an hour. So there's barely even 2 days of trading activity here. And, guessing whether the basketball player is going to dribble with his left or right. To your point, it's like this 15-minute bar. This is 5 days of 15-minute candlesticks on the S&P 500.
And it was basically a 1-day move made up all of it. Otherwise, you're sideways on each end of it. So there again, if you guessed it right, you're good to go. But if you didn't, you're choppy for the other 90%.
And here's the 1-minute bar. So every bar here is a minute, and you can see that it basically is trendless on such a short time horizon.
And it looks nothing like the S&P 500 daily or month or weekly, like you showed. So,
yep,
it's a forest from the
fast.
trees.
I mean, it's interesting how fast it'll go.
Well, I mean, that's why people like to day trade. I mean, once again, it's the same thing as in-game betting. I mean, it's for action junkies, but you're and the other thing, keep in mind, you're losing a little bit of a spread. I mean, I know the commissions are lower than they've ever been, but you're still losing a teeny bit on every trade. So once again, you better
Yep.
make sure you have an edge because it's the same with sports betting. I mean, theoretically, you're risking 11 to win 10 on every sports bet, so you need to have more than a 52.5% edge. But it's easier to find edges when you are more selective. So whether it's sports or financial markets, you're going to get chopped up if you just trade and trade and trade, even with the low commissions now.
Yep.
Back when you and I started, it was like $50 or $100 turn for a
Was.
commodity trade. That kept you honest, right? You weren't doing a lot of daily trading.
Yeah. I mean, you couldn't.
And now you can get with like interactive and stuff, you can get like a $1 or $2 turn. So it's pretty remarkable. It's like 98% less, but it also invites, I think, some bad habits also.
Yeah, it does. I mean, there's if you try to day trade, you might be better off betting on the Celtics every night as an alternative if you need that kind of excitement. Because I remember when Starbucks were just loaded with day traders in the late '90s,
Which is
and
correct.
they were masters of the universe, and you just knew from experience that the cockiness was going to get humbled in a hurry by the market, and sure enough, it did.
That's like, this year unders did really well, but a few years ago when the NFL over trend started, when the games became much higher scoring, the odds makers didn't really catch on, the public in general bets overs, or when favorites do really well, the public will be crushing it for a couple weeks and they're not doing anything but getting lucky because they're just happen to be playing favorites and favorites cover 70% during that span or something. And it's the same thing with the day trading in the late 90s. You could blindly throw a dart. Most stocks were going up. Most stocks were making monster moves on a daily basis because the market was making a monster move. But you could also just have invested in the S&P for the late 90s and made a ton of money doing nothing. So there wasn't any skill involved. You're exactly right. And kind of the meme stocks as well during the COVID shutdown.
Yeah.
And
Yep.
Bitcoin a little bit too. There is some fundamentals behind Bitcoin. Obviously, it's here to stay, I believe, but it's been a little easy for people. And we know how that normally ends.
Yep. It ends up painfully. No other way to describe it.
Well, it happens fast too. That's the problem with like the
Yep.
weekly trades. Bitcoin's been a tough one to do a weekly bar on because you get some monster moves over the course of the week, and then all of a sudden you're getting in or out at a much lower price or a much higher price. So that's what's tricky about Bitcoin. It's a very volatile commodity. I guess we can call it a commodity now.
Yeah, I would call it a commodity. Sure is interesting.
If gold's
Oh,
a
Steve.
commodity, Bitcoin's kind of like a gold, so I'd call it a commodity. It's being
Yeah.
used for the same reasons.
Yeah, it's a medium. But I guess that'll do it for today's show, unless you have anything extra. But before we do end it, I want you to be able to tell everybody where they can find you and all the good things that are going over on Wager Talk.
Yeah, wagertalk.com. Best place to go. You get my daily best bets for football, basketball, baseball. Baseball's right around the corner. Basketball in full swing. And I also post free daily plays. So if you're building that bankroll, you're new to sports betting, check out the free play every day on my page, Steve Merril, wagertalk.com. And then all the shows completely free to watch on Wager Talk TV on YouTube. A lot of NBA and college basketball content every day, a lot of solo videos as well. I knocked some of those out right before the show. So it's a great way to learn and earn for free, free plays, and also Wager Talk TV and wagertalk.com.
Awesome stuff. I remember being on that NBA show with Ranieri, and it was a blast. It was a lot of fun. Kind of miss those shows. If I was honest, I mean they were a lot of fun.
Yeah, it's funny how the NBA always has a more casual atmosphere. And I think it goes back to even like TNT, the Chuck and Kenny and those guys. For some reason, the NBA is always like the goof off show, which is typical because the NBA regular season is kind of a goof, I think. But
Yeah.
there's also some ways, as you know, you and I do very well with the NBA. A lot of people are thinking, how do you handicap the NBA? Well, it's situational, situational,
Yep.
situational. But there's a lot of money to be made still, and it's a great market.
No question. I'm ranked number 4 over at sportscapping.com out of about 100 cappers. I've used them for documentation, really, so that when somebody sees my record, it's valid. It's not something that a lot of guys make up in the air just to get you to follow them and waste your money purchasing that subscription. But I think if you go to predictiveplaybook.com or wagertalk.com and purchase Steve's or mine or any other people that are on Wager Talk or my site, they're reputable. They're not guys that just started throwing darts at a board last week. They've been in it for more than a decade, and you learn a lot. There's a lot of good times the first 10 years and a lot of times where you think you can't even pick your nose anymore, let alone a winning bet, right? But we all go through that, but we learn from it, and you just keep getting better and better. And that's what you try to do every single day. So, Steve, thanks for being part of the show, and we'll be back on next week again. I may do an individual show later this week if something big happens with Nvidia. But until then, remember, bet with your heads and not over it, and may all the wins be yours.